risk, or anytime you eat out at a restaurant, you're taking a risk. These sorts of ideas, yeah, they're kind of phrases that we push on people that don't really make any real sense when you kind of consider the realities of it on the ground. I mean, most times that you cross the road, you're taking zero risks whatsoever because you're looking across the road. Risk managed, but when you take a trade, you're not taking a risk. Actually, when your job as a trader is essentially in the buying and selling of risk, okay, at any given time, that's what you're doing. You're actually buying and selling risk. Now, that risk has got an underlying name to it. It could be gold, could be Bitcoin, could be GME, could be AMC, could be anything that you like. It could be treasury bonds, it could be forex, anything that you like. It will have a name, whatever it is. But when you're buying and selling it, you're operating on a basis of probabilities in the first place. And that is actually what you're buying is at any given time is the probability, or indeed you're selling the probability. So let's just take up a chart for a split second here, and we'll go into this in a little bit more detail. But here's a chart, and here I am, and I'm covering up all the indicators down below, actually trading it. It's unfair to say that we're buying and selling risk, really, because it's not trading, it's more like investing, okay? And that's different. These are different things. And who manages their risk when they're investing? Let me tell you, the answer to that is nobody. If you're managing risk when you're investing, you're not investing anymore, you're trading. And what is trading? Well, trading is the buying and selling of risk. Buying and selling your investments aren't trading, right? And convincing yourself that buying some underlying thing and that you're buying it when it's low and selling it when it's high, that's not trading, right? That's you actually just investing. Trading is the buying and selling of risk, okay? I don't know if anybody else out there talks about it like this, but it's certainly something that I've always looked at it like this. Always looked at it like this, right? And this is just the way, this is just the reality of it. I'm pretty sure, you know, in my experience, every time I've had a conversation with anybody that's professional about this or in the professional world or anything else like that, they've just agreed. So it's the truth, right? So we can take up any other chart, and there's tons of them out there. Let's go for something that's in the crypto world. KCS, right? KCS. That is the coin that KuCoin use on their platform, right? Just random one here to think about for a while. And take that crap off the charts for there. Right, so in this moment in time, if you're buying this and you're looking at it, a lot of people will like to do is like to say to you, you need to focus on the fundamentals and look at the names and everything else, right? And then you look at all the different details about all the stuff in the background. Actually, we're going to be going on for a minute or two longer than 5 minutes here. 4 minutes on this one, it seems, as I check my watch. So you think and you tell yourself, hey, I'm buying this, but what are you actually doing? You're bringing up a chart and you're looking at it and you're saying, this is an opportunity here or whatever. And why? Well, because you're looking at the ability for it to go up or down in price. And what you're actually buying is the opportunity at any given time to be making money on it, because you're not actually going to build your house out of the tokens that say that you own this thing. You're not going to take those digital representations of something that you own in the world and put it into the actual building that you live inside. You're not going to take it and put it in your mouth and eat it, right? Instead, actually, all you're going to do is own this thing until such times as you don't own it. And you take the alpha and the omega and you put it together and you realize that what you've actually bought during that experience was the risk of not making money, or indeed the reward of making that money. And that's fundamentally what you're doing, okay? Now, when it comes to looking at the risk management, you should do that, and you should look at the videos out there on the internet that exist. I think TradeSpotting has one. I should have one on my channel where I talk about things like how much of the risk within your portfolio you're going to take. So for instance, a lot of people talk about risking 1% of their account. So say you were trading with your entire account on this thing just here. You might be taking a trade and you might be thinking about it something along these sorts of lines, right? Just say that you were like, okay, so I'm going to trade this thing, and if it drops significantly below the 200 simple period moving average, I'm going to ditch it, and I'm going for profit targets up there or whatever, right? That's huge. Risk reward ratio 6.82 to 1, okay? Most people instead, if they're being kind of, profitable traders over a long period of time, are instead looking for something more similar to this, where you've got a 1.5 to 1. 1.5 to 1. It might not look like that to you, but that's exactly what that is on the screen, by the way. There, that red area is and the green area there is 1.5 times the size of the red area, and that's 1.5 to 1. 1.5 to 1 risk to reward ratio. This is kind of managing your risk in a sense, just because you're taking a trade, and this trade is not buying the underlying. This trade is buying and selling the risk. What is the risk? Well, this is it here. There's your reward in green. There's your risk. now you're halfway towards kind of understanding risk management. The portion of this that's missing from from what I'm talking about are the simple things along the lines of how you work out inside your position, inside your account, how much, if this happened and it went down and you closed out your position in a loss, how much that would affect your overall account. Then by doing it in small amounts at a time, you give yourself more chances across the longer term to be right on these things. And from a broad perspective, whenever you want to be profitable in trading, what you're doing is you're successfully buying and selling risk, which means that implicitly you're successfully managing that risk. So over a period of time, you'd hope then that the 1.5 to 1 risk to reward that you're taking on any trade, given that you've done analysis on it, will overall have profited at the end of a period of time, after a period of a number of trades. And how do you get through that number of trades? Well, the only way you can get through there, realizing that at times there will be attrition on your account, because over a period of time, you can be wrong under conditions where otherwise statistically you would be right. Numerous times in a row. Anybody who's played roulette and just gone black, 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 or whatever will understand that. Anybody who's ever just tossed a coin a lot of times will understand it. Anybody who's done martingale on anything in their life will understand that occasionally you get a lot of things going against you. Therefore, you need to manage your risk in order to be able to not have too much drawdown on your account, so that you've always got enough bullets left in the chamber, or dry powder if you're 21st century type analogy, or like the 19th century analogy, you've always got dry powder left so that you can take the next shot when you need to take it, so that your statistical edge in the market will work for you. And overall, that's what trading is, right? So the one component that's missing, which is the question which people will be asking if they think to get to the end of this, but Rocky, you didn't speak about that, is simply put, how to calculate how much of your account you're wanting to put onto your trade that you're making at any given time. Clearly that's going to be determined by things like leverage that you're using. Clearly that's determined by the overall risk amount that you want to be taken on in terms of, say, a percentage. Obviously it's going to be determined by these sorts of factors which you know personally, which I don't know, and you can go ahead and look at that information anywhere in the world. But risk management is essentially at the very core of what we're doing here, because a successful trader is obviously managing their risk, because whether they know it or not, what a successful trader does is operate in an industry whereby they buy and sell risk. It is what their job is. Stop convincing yourself that you're buying and selling Bitcoin. You're not. You never have been. You never will, right? That's just not happening. But you are buying and selling risk. Quite often, you eat that risk right the way up, because you're convinced that what you actually bought was Bitcoin, when you didn't. What you bought was risk, whether that's spot or whether that's leveraged. You bought risk. So whenever you hold on to a position that goes completely to zero, what you've done is you've held that was the risk that you bought, not that the stock went to zero. Okay, now you understand what trading is. That's very key.